Structured products and buffer ETFs that allow you to buy stocks with less downside risk are exploding in popularity. But are they right for you? This is Ethan with Fundamentals of Finance. I'm a CFA Charterholder and investment professional, and today I'm going to simplify structured products and buffer ETFs. Let's start with the basics. In case you've only heard of one of these terms, they're essentially the same thing. Structured products have been around for a long time. I vividly remember learning about them when I started in the industry almost 20 years ago. And at the time, I thought they were basically the coolest thing I'd ever heard of. Now, traditionally, they were only available through financial advisors, but now some versions of them are being put into ETF wrappers to make them more accessible, and those were usually called buffer ETFs. So in order to understand buffer ETFs, really, we first need to understand structured products. Now, structured products are basically some sort of an index, like, say, the S&P 500, combined with a combination of options that alter the return profile. It'll be something like the S&P 500, but with a maximum upside of 15% and a maximum downside of 10%. Or the S&P 500's return with a max upside of 10%, and you get to avoid the first 15% of losses if it goes down. It can get pretty complicated, but I'm going to take you through step by step to show you exactly how they work. Step one is a reference asset. It's something like VU, for example, the Vanguard S&P 500 ETF. Obviously, if that's all you own, then however much it goes up or down, that's your return. Reasonable? Step two is, well, let's say instead of buying VU, you wanted to buy a call option on it. A call option is when you pay for the right to buy a stock or an ETF, like VU, at a set price. So here in our example, I've set the premium, aka the cost to buy the option, at 5%. I'm going to stick with percentages throughout this video to keep it simple. So you pay 5% for this option, which gives you the right to buy VU at its current price. Why would you do this? Well, if VU goes down 50%, you don't have to buy it, and you're only out the 5% you paid for the option. You can see how regardless of whether VU, the green line, is flat or down 50% or down 30%, the return on the call option is just negative 5%. But if VU goes up, no matter how high it goes, you can still buy it for its current price. So you get all the upside in VU minus the 5% you paid for the call option, but no downside risk beyond that. Step three is when you own the underlying asset, VU in this case, and one or more options together to create a structure of returns the way you want them, hence the name structured product. Then you could also do this entirely with options, but we'll get to that later. For this example, let's say the main thing we want to do is cap our downside risk at 15%. And you might do this if you were, say, okay with some losses, but just didn't want to lose more than that. Well, for that, you can buy a put. A put option is sort of like the opposite of a call option. Instead of buying the option to buy the ETF if it goes up, you're buying the option to sell the ETF if it goes down. Let me show you. Here, you own VU plus a put option. It lets you sell at 15% below the current price. So let's say it costs 2% to buy the option. If VU goes up, you own it, so you get all of its upside minus the 2% that you paid for the option. If VU goes down, say 7%, you lose 9% because it wasn't down enough for your put option to trigger. You still paid 2% for it. However, if VU goes down 20% or 30% or 50%, you only lose a maximum of 17% because the put option lets you sell VU down 15% no matter how low it goes. So that's all you can lose minus the 2% you paid for the option. 15% downside plus 2% option cost equals a 17% max loss. So almost all the upside and limited downside exposure. Okay, we're getting somewhere. But what if you don't want to pay for that option? Or if you just don't want to lose more than the market if it only goes down 7%? Well, then in addition to holding VU and buying that put option, you can also settle a call option. In this example, the put option you bought to cap your downside cost you 2%, but the call option that you sold made you 2%, so the costs offset. However, of course, there's no free lunch, like most things in life, right? The trade-off here is that when you sell what's called an out-of-the-money call, meaning it's not worth anything at today's price, you cap your upside. So you own VU, you bought an out-of-the-money put, and you sold an out-of-the-money call. The option premiums offset, and you just have your investment in VU, but with a max upside of 15% and a max downside of 15%. If VU goes up 5%, both options are worthless, and you own VU, so you make 5%. Same as if it goes down 5%. Anywhere between minus 15% and plus 15%, you just get VU's return. However, if VU goes up 20%, you only make 15% because you sold a call option that lets someone else buy your VU shares at 15% above the current price. That's why your upside is capped. It's the same if it goes down more than 15%. You bought the right to sell your VU shares to someone else at 15% below the current price. So you really can't lose more than that. Of course, in real life, these structured products are often structured so that your upside potential is greater than your downside potential. But you can see how by choosing different combinations of options with different strike prices, you basically can structure the kind of return profile that you're looking for, within reason, of course. Here's where we get to buffer ETFs. In the example I just showed, the upside and downside were capped, meaning you participated in the upside and downside up to a point, but then they maxed out. Buffer ETFs are usually the same on the upside with the cap, but different on the downside. Instead of participating in the first 15% of losses and then no more than that, they're often structured so that you avoid the first 15% of losses, but then participate after that. Translation, you're less likely to lose money, and if the market goes down, your investment will go down less. But technically, you have much more downside potential than upside potential because your upside is capped while your downside is only buffered. Let me show you how it works. In this example, we're going to create a synthetic position in VU instead of buying it directly, since that's what a lot of buffer ETFs do. One way to do that is to start buying an at-the-money call option, the right to buy VU at the current price if it goes any higher, and then selling an at-the-money put option so someone else will have the right to sell you VU at the current price if it goes any lower. So with a synthetic position, you don't actually own any VU, but the price you paid for the call option that you bought and the price that you received for the put option that you sold offset. Both strike prices are at the money, so if VU goes any higher, you'll use the call option to buy it at the current price and capture all those gains. If VU goes any lower, the person that you sold the put option to is going to sell you their VU at the current price, so the losses will be put onto you, not them. Thus, it's basically the same thing as owning VU. Well, actually, you don't get the dividends this way, and it might be less tax efficient, so it's not quite as good as owning VU, but this is how a lot of buffer ETFs do it, so I thought it was worth explaining. You can also create a synthetic ETF position with another derivative called swap, but that's probably beyond the scope of this video. The main point is, step one in a buffer ETF is getting exposure to the underlying asset, whether it's buying it directly or creating a synthetic positioning. For simplicity's sake, I'm going to go back to the black line and refer to the position as VU in the rest of this example. By the way, for this part, I'm going to reference a real buffer ETF, AUNP from Prudential, which aims to provide a buffer against the first 12% of losses and has a return clap of 15.05%. This isn't a recommendation, obviously, as nothing on my channel is. I just picked Prudential because, to be honest, they paid the most for Google ads and came up first when I typed in buffer ETF. I just thought it would be helpful to use real numbers for this part. They used SPY instead of VU, but they're basically the same thing. So let's stick with VU, and our charts could keep it consistent. Once you've got your reference asset, your VU or synthetic VU, the next step is to buy an at-the-money put option for downside protection. That protection on the downside, but it's expensive. So in order to pay for that, in step 3, a buffer ETF will usually sell 2 options that make up for the cost of the put that they bought for the downside protection. The first one, and the order is important here, the first one is an out-of-the-money put option. That's what results in the red line on the left. So remember, in step 1, you bought VU, that's the black line. Then you bought a put option at the money, meaning you get to sell your VU to someone else at the current price if it goes down. That's the yellow line. But then you sold a put option out of the money at the desired buffered level, which in this case was 12%. That's the red line. So there are two stages here if it goes down. If VU goes down between 0 and 12%, you don't lose any money. If VU goes down more than 12%, you go down right with it, but you beat it by 12%. So if VU goes down 15%, you go down 3%. If VU goes down 20%, you go down 8%, and so forth and so on. However, out-of-the-money options, like the one you sold for income, don't cost as much as at-the-money options or in-the-money options, like the one you bought for downside protection. So, to fully pay for the cost of downside protection, buffer ETFs will also sell an out-of-the-money call option. Why does this one come second? Because the number one thing people care about in buffer ETFs is the buffer amount. You set whatever your target is, which in this case was 12%, a nice, even, mean 12%. Then, whatever the cost difference is that you still have to make up for, that's how much income you need from selling the call option. The cap on the buffer ETF will change each time depending on the option pricing, and that's why this one is set at a seemingly random 15.05%. So to recap, buffer ETFs start with the underlying position, or a synthetic version of it, which is called the reference asset. Then they build in their downside protection by buying a put option, and they pay for that downside protection by selling an out-of-the-money put option and an out-of-the-money call option. In our example here, we have a cap of 15.05% on the upside and a buffer of 12% on the downside. That means that if VU goes up between 0 and 15.05%, you make VU's return. But if VU goes up more than that, your return is capped at 15.05%. If VU goes down between 0 and 12%, you stay flat. But if VU goes down more than 12%, you go down too, but just 12% less than VU. So those are the mechanics of how structured products and buffer ETFs work. But if you're considering buying one, here are a few more things you should think about. 1. ETFs also have fees. So the numbers I've been showing here are only for illustrative purposes, and the returns in all the scenarios will be slightly lower than that due to the ETF fees. On this one, JUNP, it's 0.5% per year. 2. The synthetic exposure usually only covers the price return, meaning it doesn't include dividends. So that's another reason that the returns on buffer ETFs will usually be a little lower than the return on the underlying asset than you might have expected based on the mechanics that I showed you of how they actually work. That's something to keep in mind. The third thing to think about is that the returns on these ETFs that they aim for, they're only over a certain period. And if you're not starting at the beginning of one of those periods, then the cap and buffer will be different from wherever you are. You can usually see what the updated cap and buffer amounts are from today's date if you go on the ETF's website. 4. As far as where these fit in a portfolio, there's definitely a range of them, but in general, I would describe them as less risky than stocks and more risky than bonds. They're probably most appropriate for a retiree or a wealthy person who's looking for equity exposure, but is just more concerned with reducing potential losses than maximizing potential gains. If you found this video helpful, please do me solid and hit that like button, hit that subscribe button, and share it with whoever you know that you think might find it helpful. And if you'd like to continue the conversation, check out the link below to join my free Discord, where we have a whole community of people geeking out on investment topics daily.